Most middle-class families are working hard, but nobody ever taught them the real money rules. The rules that actually build wealth, protect your family, and break the cycle of financial struggle. Today, Pete is walking you through 7 steps that can turn $50,000 into $500,000. No get-rich-quick schemes, no complicated jargon, just math, strategy, and the willingness to start today. These are the rules the wealthy already know, and the ones most families were never shown. Stick around until the end, because Step 7 alone could completely change what you leave behind. Before we get into the steps, let's talk about where most middle-class families actually stand right now. The median middle-class family has around $45,000 to $60,000 in total net worth today. That number sounds decent until you realize how fast inflation, debt, and fees are eating it alive. The families pulling ahead aren't earning more, they're simply following a different set of financial rules. And the beautiful thing about rules is that once you know them, you can use them too. So grab a pen, screenshot this, do whatever you need to do, because this is your checklist. Rule 1. Audit your finances and find every single leak before it drains your future dry. You cannot fix what you cannot see, and right now, money is quietly leaking out every month. For the next 90 days, track every single dollar coming in and every dollar going out completely. Use a free app, a spreadsheet, a notebook, whatever works for you, but you must track everything. What you are hunting for are the leaks, the small, silent charges bleeding your account every month. Bank fees alone cost the average middle-class family hundreds of dollars every single year unnecessarily. Overdraft fees, maintenance charges, subscriptions you forgot about, these are all money walking out your door. Here is the math that should make you angry enough to finally do something about it today. If fees are costing you $2,000 a year and you invest that instead at 7%, that becomes $15,000 in 10 years, $34,000 in 20, and $80,000 in 30. You were just handing that money away to institutions that already have more than enough of it. There's also a cultural leak nobody wants to talk about, and it is called being the one. Being the one everyone calls when rent is due, when the car breaks down, when bills stack up. Family matters deeply, but you cannot set yourself on fire to keep everybody else warm around you. Create a giving fund. Cap it at 5% of your income. Put it in a separate account. When that account is empty, it is empty, and that boundary is not selfishness, it's strategy. Rule 2. Build a bulletproof emergency fund, because without one, you are one bad day from disaster. More than half of middle-class families cannot cover a $400 emergency using cash they already have. $400! That's a car repair, a medical copay, one single unexpected bill arriving today. Without that cushion, one bad month does not stay one bad month, it becomes one very bad year. Your target is 3 to 6 months of living expenses sitting in a high-yield savings account now. Right now, you can find accounts paying 4 to 5% annual returns at online banks easily. Start with $1,000 as your first milestone, then automate $200 every single month automatically. Set it, forget it, pretend it does not exist until the exact moment that it needs to. Here's why this matters more than most people realize when they first hear the advice given. The unemployment rate swings hard during recessions, and middle-class families get hit first and rehired last, unfortunately. Your emergency fund is not just savings, it's armor protecting everything else you're trying to build. Without it, a $1,000 car repair becomes a payday loan, charging nearly 400% interest annually. That $1,000 emergency quietly becomes $4,000 of debt if you're not protected going in. But $5,000 sitting in a high-yield account grows while simultaneously protecting you from financial predators completely. That's not a savings account, that's self-defense, and every middle-class family needs it built first. Rule 3. Crush your high-interest debt because every month you carry it, it's crushing you back. Credit card debt is wealth kryptonite, and the math on what it actually costs you is brutal. A $10,000 balance at 25% interest, paying only minimums, takes over 30 years to eliminate completely. Over that time, you'll pay $22,000 in interest alone on a $10,000 balance. The credit card company made more money from your debt than you ever made from borrowing it. Here is your attack plan. List every single debt, the interest rate, the minimum payment, and the balance. Then pick your weapon. The avalanche method targets the highest interest rate first and saves the most money. The snowball method targets the smallest balance first, builds momentum fast, and keeps you psychologically in the game. Both methods work. The only method that fails is switching between them every couple of months repeatedly. Using the avalanche method aggressively on that same $10,000 debt, you're paid off in 3 years. Total interest paid drops from $22,000 all the way down to just $3,000 total. You just saved $19,000 and 27 years of your life by simply choosing the right method. That's not financial advice, that's arithmetic, and arithmetic does not care about your feelings at all. For student loans, look into income-dependent repayment plans and public service loan forgiveness if you qualify for them. The Consumer Financial Protection Bureau exists to protect you from predatory lenders, so learn how to use it. Rule 4. Invest consistently in low-fee index funds because the stock market compounds for you or against you. Only a fraction of middle-class families own stocks, and that gap is one of the biggest wealth dividers. The families building real wealth are not picking stocks, they are buying the whole market at low cost. Open a Roth IRA or maximize your employer's 401k match starting today, not next month, but right now. If your employer matches contributions and you are not taking it, you are literally leaving salary on the table. You are doing the work and accepting a discount on your own paycheck every single pay period unnecessarily. Put your money into low-fee index funds like Vanguard Total Market or Fidelity Zero funds and hold them. Keep fees under 2% because high fees are just another quiet leak draining your long-term wealth silently. Now watch what the math actually does when you simply stay consistent and let compound interest do its job. $500 a month at 7% average returns over 25 years becomes $450,000. That same money sitting in a regular savings account at 4% becomes only $157,000. The stock market is not gambling. Staying out of the stock market while inflation runs is the real gamble. Low-fee index funds do not have opinions, they do not pick favorites, they simply compound whatever you put in. Start today, stay consistent, keep fees low, and let the math do the heavy lifting for your future. Rule 5. Diversify your income streams, because one employer should never control your entire financial future completely. A single income stream is the most fragile financial position any middle-class family can find themselves sitting in. One layoff, one medical event, one company decision, and everything you have built starts unraveling incredibly fast. Your goal is to have 20% of your total income coming from a completely separate source entirely. Side hustles, freelancing, digital products, consulting, rental income, online businesses, all of these count toward that target number. $1,000 a month from a side income invested at 8% returns becomes $592,000. in 20 years. That is not a side hustle anymore. That is a retirement plan running alongside your career. That is, I do not need this job anymore money, and every middle-class family deserves to know what that freedom actually feels like. Platforms like Upwork, Etsy, and Fiverr do not see your zip code, your history, or your circumstances at all. The internet gives you the ability to build income streams completely outside of traditional systems and their invisible limitations. Start with one stream, build it to $500 a month, then build the next one after that. Rule 6. Buy real assets, especially real estate, because equity builds wealth while you sleep every single night. Home ownership is the primary wealth-building vehicle in America, and most middle-class families are not using it fully. A $300,000 home appreciating at 4% builds roughly $150,000 in equity over 10 years. That is wealth growing in the background every single day, whether you're thinking about it or not. If you're a first-time buyer, look at FHA loans requiring as little as 3.5% down today. Research down payment assistance programs in your state because most people have no idea how many actually exist. Consider house hacking. Buy a duplex, live in one unit, and let your tenant pay your mortgage monthly. You build equity, reduce your living costs, and generate income all from a single smart purchase made once. Real estate is not just shelter. When bought correctly, it is a wealth engine running quietly in the background. Rule 7. Plan for your legacy now, because without a plan, courts and lawyers decide what happens next. 70% of middle-class homeowners over 50 have no will, no trust, and no plan in place today. When you die without a will, the state steps in, courts get involved, and families fall apart painfully. Your legacy becomes a courthouse battle instead of a blessing passed cleanly to the people you love most. Get a will today. LegalZoom, Trust and Will, a free legal clinic, whatever works, just get it done now. It takes about 1 hour and costs less than dinner for two at a decent restaurant near you. Life insurance is non-negotiable if anyone depends on your income to survive and maintain their current standard of living. A $500,000 term life policy costs around $30 a month, about the same as one streaming subscription. Whole life insurance is expensive, commission-heavy, and returns far less than term life combined with consistent index fund investing. Term life, simple, affordable, and exactly what your family actually needs without any of the unnecessary complexity added. Finally, open a 529 plan for your children. $100 a month at 6% for 18 years grows to over $40,000 for college. And children with savings accounts are 6 times more likely to attend. You are not just saving money, you are mathematically increasing the probability of a completely different future for them. Now let us tie all 7 rules together and look at what consistent execution actually produces over time compounded. A family starting at $50,000 in net worth and following all 7 steps consistently and patiently can realistically reach $1 million in net worth within 30 years. Not hope, not motivation, pure math. Audit your leaks, build your armor, crush your debt, invest consistently, grow your income, buy assets, protect your legacy. The same compound interest that quietly worked against your family for years can now quietly work for them instead. Will it require discipline? Yes. Will there be setbacks? Absolutely. Will it be worth it 30 years from now? When your children start from strength instead of debt, you will know exactly why you started today and persisted. Pick one rule, just one, and take one action on it before you go to sleep tonight specifically. Not next paycheck, not next month, not when things calm down. Tonight, because the best time is always now. If this video gave you even one idea that changes how you think about building wealth going forward permanently, please like this video right now. It helps Pete reach more families who need to hear this message today. Subscribe to the Pete Invests channel so you never miss a strategy, a breakdown, or a rule like these. And turn on the notification bell so every new video comes straight to you the moment it goes live. New videos drop every week covering the money systems, the hidden rules, and the quiet paths to real freedom. Thank you so much for watching. Now go take that first step. Pete will see you in the next one.